Welcome to the market's mindset. Let's talk about one of the most frustrating realities for traders, that feeling of doing everything correctly, following your strategy to the letter, and still not seeing consistent profits. You follow your rules, you study price action, you know your setups, but somehow, the results just don't line up. Why is that? Most traders immediately look for answers in strategy. They assume they need a better indicator, a more accurate entry, or some kind of secret edge they haven't found yet. But in truth, consistency has less to do with what you trade, and everything to do with how you trade it. Let's break down the real reason you're not consistent, and what to do about it. Part 1. The illusion of progress. Most traders go through a period where they feel like they're improving, they're studying, backtesting, watching videos, and getting deeper into the craft. It feels like progress. But progress in trading doesn't always show up as profits right away. See, the market doesn't pay you for knowledge, it pays you for execution. You can have the perfect plan on paper, but if fear, greed, or hesitation creep in when the candles start moving, that plan goes out the window. Consistency isn't about how much you know, it's about how often you can act without breaking your own rules. That's the real skill, and it's a lot harder than memorizing patterns or studying indicators. Part 2. The discipline gap. There's a massive gap between knowing what to do and actually doing it. Every trader knows they should cut losses quickly. Every trader knows they should wait for confirmation. Every trader knows they should size their positions according to risk. And yet, when they're in the middle of a trade, something changes. Emotions take the wheel. You start hoping instead of reacting. You convince yourself this one will turn around. That's not a lack of skill, that's a lack of discipline under pressure. And this is where consistency either lives or dies. True consistency means your actions don't change when your emotions do. That's the mark of a professional. Part 3. Emotional sabotage. Most traders sabotage themselves because they haven't learned how to handle emotional intensity. When you risk money, your brain interprets it as danger. You might know you're risking $50 or $100, but your nervous system reacts like you're facing real physical threat, so it dumps cortisol. Your heart rate rises, your decision-making ability drops. You start seeing what you want to see instead of what's really there. In that state, logic doesn't stand a chance. You're not trading the chart anymore, you're trading your feelings. That's why journaling, breathing, stepping away, or lowering size are not optional. They're survival tools. They keep you calm enough to make rational choices. Part 4. The need for emotional neutrality. The best traders don't trade without emotion, they've just learned not to act on it. They feel fear, greed, and frustration like everyone else, but they don't let those emotions dictate their next move. They've trained their response. And that training comes from one thing: repetition under control. The next time you catch yourself overtrading, hesitating, or chasing, don't get angry. Recognize that you're being triggered emotionally. Then, take a breath and consciously choose the opposite action. That's emotional training. That's how consistency starts. Part 5. The false belief in fixing emotions. You'll never eliminate fear, greed, or impatience. If you wait until you feel perfectly calm before taking a trade, you'll never take one. What you can do is build a system that keeps your emotions from having too much influence. That means setting clear risk limits. That means predefining exits. That means removing yourself from decisions that should already be automated. Professional traders don't trust their gut, they trust their process. Part 6. The process first mindset. Ask yourself, do you judge your performance by how much money you made, or by how well you followed your plan? Most retail traders focus entirely on outcome. They measure success trade by trade, which creates constant emotional swings. One win feels euphoric, one loss feels devastating. Professionals focus on process. They don't judge themselves after 1 or 2 trades. They judge after 20, 50, 100, because they know short-term results are noise. But the process is signal. When you start measuring your consistency by how well you execute, not by how much you make, you stop chasing outcomes and start building habits. Part 7. Why you're not consistent. The truth. You're not inconsistent because you're bad at trading. You're inconsistent because you haven't yet learned to be the same person in every trade. One day you're calm. The next, you're impulsive. One day you wait for confirmation. The next, you jump in early. That's inconsistency. And it's 100% psychological. The market isn't testing your strategy, it's testing your ability to remain stable under changing conditions. When you finally learn to show up the same way every day, with the same mindset, same execution, same control, that's when your results start to stabilize. Part 8. The fix. Start journaling with brutal honesty. Not about your setups, but about your state. Ask yourself after every trade, what was I feeling before I entered? Did I act on emotion or logic? Did I break or follow my rules? What triggered me most today? Then write it down. You'll quickly see patterns that have nothing to do with the market and everything to do with your behavior. That's the real work of trading. Part 9. Detach from outcomes. The irony is that you'll only start making money consistently when you stop trying to make money on every trade. When your only goal becomes executing well, profits become a byproduct. If you focus on chasing profit, you'll force trades. If you focus on execution, you'll trade less, trade better, and make more. Detach from the outcome. Focus on the action. Part 10. The takeaway: the real reason you're not seeing consistent profits isn't your strategy, it's your state. It's the emotional inconsistency between trades. It's the small acts of discipline that get skipped when pressure builds. It's the story you tell yourself mid-trade that convinces you to do something different just this once. Consistency is not about predicting markets, it's about controlling yourself. And that's what separates the professionals from everyone else. Thanks for watching. Please like and subscribe.